The remnants of one of the strongest earnings seasons in recent years saw equities again hit new all-time highs in August. In contrast, global bond investors succumbed to modest rises in both U.S. and German risk-free yields. August also marked an important milestone for the current bull market, with the S&P 500 now having gone more than 200 days without a 5% correction. The rally since November of 2020 now joins only 6 other similar episodes going back to the 1950s. For many clients, this brings worry that such a rally can't continue much longer. However, looking back over the last 70 years, having reached the 200-day milestone, over the next year, risks of a meaningful decline have been modest outside of external shocks to the system. Indeed, this is consistent with the mini-cycle narrative that we've been outlining in recent months. Investors should continue to look for more modest but positive earnings-driven returns accompanied by elevated volatility looking ahead. Thus, rather than withdrawing from markets as some may be inclined to do after such a long rally, we are instead rotating within portfolios to increase the quality of the holdings that will underpin returns looking into the year ahead. In particular, just as we saw U.S. big tech companies find a durable valuation floor in May to accompany their strong earnings growth momentum, we believe the global pharma sector is offering a similar setup now. Typically trading in line with the broader market, global pharma sits near decade-low valuations against the broader market. More importantly, having seen sector earnings revisions lag the overall market in the pandemic era, the past several months have seen positive earnings revisions momentum return to global pharma, giving them an earnings tailwind to complement their valuation floor. With the U.S. Congress set to enact new fiscal measures that could total as much as $3 trillion, investors should expect risk-free yields to continue to move higher looking into year-end. This should continue to provide a headwind for bond investors as a whole. As a result, we remain focused on protecting against rising interest rate risk and looking to accept credit risk via short-duration, high-carry strategies in portfolios. For more information about how we're protecting against this rising interest rate risk, as well as opportunities we see in quality equities, please visit us on ubp.com.